B-lender mortgages have becoming really popular in Canada. One, because of the increasing interest rates we've seen in the past 2 years. Secondly, because bank lenders have been continuing to tighten up their lending criteria, so it's making it really hard for everybody to qualify for a mortgage, and B-lender is a great alternative. Let's get started. So what are the pros and cons? There are a few, and let's dive into them. When it comes to pros for B-lender, there are 3 major things. We're gonna start with one pro and one con so we can actually compare them side by side. The biggest advantage when it comes to B-lender mortgage is the flexibility of income and credit. For A-lenders, your income has to be very standard. A-lending mortgages are designed for a T4 employee who have long tenure, who work in a regular job, who gets their T4 and pay stub regularly. There are some programs within A-lenders that take into account of self-employed and people who have higher liquid asset numbers, but it's a very small fraction. With A-lenders, the credit score needs to be 680 plus. However, with B-lenders, there is no minimum credit score per se. We've gotten deals approved at under 500 credit score, so there is no minimum credit score. With B-lenders, it's all about the business case. It's all about how you present your deal to the lender, or how your mortgage professional present a deal to the lender. However, when it gets to 500 credit or lower, it becomes very difficult. Not only B-lenders don't have a minimum credit, they also can pay out your consumer proposal. Sometimes they'll allow you to keep a small balance of your consumer proposal. Those are all part of the flexibilities provided by B-lenders. So with that, one of the kind of disadvantage of B-lenders is that it needs 20% minimum down payment. With an A-lender mortgage, because they have higher income and credit requirements, when it comes to down payment for A-lenders, they can take as low as 5%, up to 500,000, and then 10% from there onwards. With B-lenders, the minimum down payment is 20%. It has to come from your own savings or investments, or it can be from a gift of a direct family member, but also cannot be borrowed. We have a lot of people come to us asking if they can borrow their down payment. The answer is no, it cannot be borrowed. It has to be from your own savings. Pro number 2, B-lender mortgage rates are cheaper than private lender mortgages. A lot of people have the misconception that B-lender mortgages are really expensive. When I think about whenever someone brings up a B-lender, they'll be like, no, it's not for me, it's too expensive. However, the rates are actually quite comparable to banks, and they're a lot cheaper than private mortgage rates. The con is B-lender mortgages are more expensive than banks because it's considered higher risk for lenders. The cost of funds for lenders are more expensive. Pro number 3 is that B-lender can help you improve your credit. The most common use case for B-lender mortgage is for people who have accumulated higher interest debts, or their credit score are not great, or they're in a consumer proposal, and that's precisely why they can qualify for an A-lender mortgage. And then when they come to a B-lender and get a B-lender mortgage, we can consolidate all their debts into their mortgage payments. And when you actually consolidate everything, including high interest, especially high interest rate credit card debts, into a fixed mortgage payment, it improves your credit score drastically, and you might be able to put everything, including credit card, car loans, personal loans, payday loans, and your existing mortgage, all into one monthly payment. And as long as you keep making that payment, your credit score is going up and up, and by the end of 12 months you might be able to go back to an A-lender, and that's really the most common use case that we've seen. The other part, which I didn't write this ahead of time, is that it is a great tool for self-employed borrowers to qualify for a bigger mortgage. That B-lenders are able to use cash flow instead of your taxable income to qualify. In fact, a lot of B lenders don't even need your T1 general. They don't actually ask. They don't need to know how much you reported. All they need to look at is your bank statement. If you're self-employed, there's so much flexibility that you can maximize your income when you try to qualify for a mortgage with B lenders. B lenders are quite picky with locations and the conditions of the properties. So a lot of the A lenders will go up north in Ontario. They'll go to rural areas. That not to say B lenders who don't do rural properties at all. There are some B lenders who specialize, who are more flexible with rural location. Hopefully you find this video informative and helpful in your mortgage search. If you like our content, give us a thumbs up. Hit subscribe to stay tuned for mortgage and financing news. Thanks for watching. Until next time.